So one of the things that if I'm a stock picker, right, my concern is even better for me. Okay, so let me show you the charts. Now this is S&P 500. Okay, all-time high, looks scary. I turn on the weekly chart. Of course it looks scary. And then I put on Nasdaq, it looks scary as well. All of them are all-time high. MSCI World, all-time high. Europe, all-time high. Europe 50. Right, and Asia just about to turn up. Oh, look at that, man. If you've been buying Asian stocks, my god, terrible, right? So but it's cheap. Okay, it's not all-time high yet. Emerging market sideways. Look at China, finally begin to awaken. Okay, so what I'm trying to tell you is, if you are just buying funds, of course it looks scary, it's all-time high, but what do you do? But look at, I have a very systematic way of measuring things, looking at the moat, looking at the ROIC, looking at the debt, looking at whether the founders are running the company. The founders, if they run the company and they own more than 10% shares, or they are still in the chairman executive position, they tend to outperform by 3 percentage points, okay, per year return. And whether the company is engaging in share buybacks, all these matters. And I predict, based on that, estimate the total shareholder returns, which is actually based on dividends, dividend yield, earnings growth, free cash flow yield, or the earnings yield right now, what you're getting from buying the company, share buybacks, okay, and multiples, earnings multiples change. So it's whether the PE ratio goes from 10 to 15, then you get returns from there. Okay, now a lot of the stocks are all-time high. Of course, the best quality stocks are at the peak. And let's look at Google, Nvidia, maybe Medpace. Of course, they look high. So this is Nvidia. See? Scary, right? Nvidia, Google, Microsoft. Now, however, there are also quality companies that have gone down a lot. United Health, look at how much it's fallen to. Copart, what is United Health? It's a insurance company. It is a high quality business. So let me show you how I would decipher them. Overview, provision of healthcare coverage. Okay, most of the business, United Healthcare's most of the business is insurance, followed by drugs. Optum RX, Optum Health, these are all smaller business, and majority of it's in US. Okay, is it a quality business? You want to see whether the earnings are growing every year. Revenue is growing every year consistently. Diluted earnings per share, basic earnings per share growing consistently except this year. Okay. Balance sheet, net debt is very manageable out of the total assets, and it's also less than equity, net debt. And let's look at the cash flow from operations. Most of the years growing at double-digit returns. Free cash flow, most of the years, out of 5, only 2 years is is negative. And let's look at P ratio, common shares outstanding. Look at this. The share count is dropping. They are buying back their own shares. The number of shares are back. There's only one reason companies buy back their own shares. It's very cheap. And then look at the return on equity, because it's a this company, they tend to be more geared. Yeah, you pay premium, and these are not part of the assets. And ROE is more representative. It's all double digit, 20 above 15% return. Okay. So these are all the consistent parts of it that's showing. Dividend wise, consistently growing every year. Earnings wise, most of the quarters they are beating the estimates. You can see here the green line. Only some quarters they are losing. The last 2 quarters, hence the share price went down. Okay, so it's a quality business and it's down 50%. And from my estimates here, and I can go down the list, right, of the companies that are being beaten down due to temporary bad news. United Health probably has about 40% return per year, and it's also 40% below the fair value. And there are quite a few good companies. Nike is finally recovering, also a quality company, but I'll be selling it out because I think their moats is quite narrow, but they've been beaten down and it's slowly turning. It's a long way up. Returns are pretty good. So you see, when you're a stock picker, there's always something to buy. Of course, then you have Novo Nordisk, pharmaceutical company, all the way down 47% return and 47% below market, below their fair value. Look at how much it's dropped. And let's look at the financials. They specialize in diabetes, obesity care, yeah, right. Revenue breakdown, diabetes, overall huge portfolio, and their countries of geographical exposure is quite diversified. Let's look at the income statement. All 5 years are up 20 over percent. That's a great consistent company, right? Excuse me. Look at the earnings, basic earnings per share. Fantastic. Why did they drop? Because of earnings guidance. And other drug companies are producing better drugs. Does that make them bad all of a sudden? Let's look at this. Very little debt. Okay, most of the time they are net cash. Free cash flow growth. Most years are, except this year. So statistically, average PE ratio, the number of share count, total shares outstanding, is falling. They are buying back their own shares. Free float is falling, which is good. They are buying back. If the business is good, they feel that it's cheap, they will buy back their own shares. PE ratio 15 times is well below the average. Return on invested capital, look at this, 51%. Margins are consistent, net margins are 34%. Is that a good business? Fantastic. It's only the quick ratio and current ratio is a little bit tight, but debt to equity ratio below 1. Absolutely no problem. Dividends consistently rising every year. Payout ratio only 36%, that's fine. And they have been beating the estimates. So this is a great company, right? And so like I said, if you're a stock picker, there's always something to buy. Always some great business at great discount because of temporary problems. We can look at Copart. Copart is a car auction company. They own the junkyard, the scrapyard. Every time a car gets written off, the insurance company, which means that the cost of repair is higher than the salvage value of the car, the insurance will write it off. So they will, Copa will offer to take it back and then auction it off and earn a commission. They have a huge network and they actually own the land of the scrap yards. So actually the land is valued at cost. So there's a lot of upside to it. It came down because the CEO guided down the earnings. Similarly to United Health, right? Back to United Health. They have been expanding their revenue by taking a lot of substandard risk. That means patients that are highly likely to be not well and likely to claim. And later on, the claims started to go up. They made a loss. But they know their mistake. So next year, they actually are expected to increase their premiums as well. So look at Elevance Health. It's the same thing. A lot of insurance companies go through the same cycle. So if you ask me, the opportunities are there. This is one of the bull runs where it's so different or so divergent. The good companies, the techs, the communication companies like Meta is flying through the roof up on a new high, and then the insurance and healthcare companies and a few other good quality companies are their 52-week low. So if I were to buy this, even if the stock market had a big correction, I'm already buying something at 50% discount. I'm not worried at all. So from the perspective of a stock picker, it's very different from if you're a financial advisor that can only able to recommend funds. And it's a quantum leap. So don't worry about it. We're going to shore up a bit more cash along the way as the market hits a new high. But we should end the year strong.